look into your eyes, I see an angel in the sky, sent from God above, the little love to hold and idolize. And as I hold your body near, I see this money through a years. And then forever on till life is gone, I keep your loving near.
Hi PME, I'm Guan Yan. Welcome to my Lightyear TV. If you have not subscribed to my YouTube channel, please do so by clicking the subscribe buttons below. Today I got something very exciting I want to share with you on how I structure my investment portfolio, and I call it as a asset allocation. But before I share with you what is asset allocation, let me share with you what is macroeconomy. Today, if I got a pen selling you at $5 and you buy it from me, and this is what we call a transaction. So let's say we extend it to example, you buy food, you take public transport, or even you go to see a doctor, and we combine all these activities together, then we call it as a economy. And let's say we extend the skill and scope to the worldwide, then we call it as a macroeconomy. So what are the factors that will impact this macroeconomy? For example, interest rate, liquidity, inflation, and growth. Because there are more like import, export, unemployment rate, etc. So why we need to study this macroeconomy and the factors that impact the macroeconomy? Because these are going to impact the asset classes that you and me invest our money in. What are the common asset classes that we put our money in? So example, right? Okay, normally we also put our money in the bank to earn the interest. So I call it cash. So we also got bonds, stock and shares, real estate, commodity, and gold. So let me take you an example. So let's say in today's terms, right? Let's say the economy is booming, and it's a clear sign that the economy is growing. So by assuming, right, interest rate, liquidity, and inflation remain unchanged. So what do you think are the asset classes that will perform? Gold, stocks, real estate, and commodity will perform because, right, in the economy growing, there are more spending, and these stock, real estate, and commodity will increase in their prices. Okay. Okay. For me, right, my investment portfolio is being engineered to prepare for different scenarios and also prepared for these three risks that I will highlight to you later. So the first risk, inflationary risk. Second risk, deflationary risk. Third one will be the black swan. Okay. So let me use this history of the stock market and the Dow Jones Industrial Average to illustrate to you. And the first risk I want to highlight to you is called deflationary risk. And this is happening during the last Great Depression. So actually in 1920, there is a lot of people invest their money, they speculate the market. And the stock market reaching a record high in August 1929. But actually at that point of time, right, the production already slowing and the unemployment rate already rising. So it's happened that starting from September, October of 1929, the stock market starting to decline and eventually lead to the Black Thursday and Black Monday event. So we heard about the Black Friday, right? Probably you not heard before what is Black Thursday and Black Monday. So for Black Mondays, right, what it means is that the stock market collapsed completely that day. And at that point of time, right, 16 million shares were traded in a single day in the New York Stock Exchange. Billions of dollars were lost and thousands of investors have been wiped out their resources. So at that point of time, right, combining with other factors, example, by low wages, proliferation of debt, struggling agriculture, and a lot of bank loans that can't be liquidated. So all these factors combined, right, that it lead to the Great Depression. Okay, what do you think, right, are the asset classes that can be invested during this deflationary environment? So the first asset class is gold. So gold actually have been increased in price about 67%. So let me, why gold is increased in price during the deflationary environment at a point of time? So actually in 1933, President Roosevelt ordered all the people to gather all their gold coin, all their gold bar, all their gold certificates to be put under the US Federal Reserve. This will enable the US Federal Reserve having their gold reserve increased by 69%. This will enable the country, governments to bring a lot of money to help the economy. Okay. Second is bond. Bond also increase in price by 28%. Mature and stable, or in today's terms, right, we call it as a mature and stable companies like SBS Transit. Do you know how SBS Transit make their revenue? Actually, they are getting their revenues from LTA, which allow them to operate during Singapore circuit breaker last year without much affecting their revenue. And this kind of company, we can invest our money in during the deflationary environment. And last one will be the structural growth companies. The structural growth companies, right? Example, the company like Microsoft, and they are doing well last year during the COVID situation. The CEO of the Microsoft, Satya Nadella, come out and mentioned that their 2 years digital transformation project have been happened in 2 months because of the COVID situation. And this kind of company continue to structure their companies and not only depend on the economic growth, but they're able to develop and structure themselves to take advantage of the market. Okay, so let me bring you to the second risk that I want to highlight to you, and it is happening during the 1970. At that point of time, we call it as a great inflation. Okay, so at that point of time, right, in 1971, so President Nixon decided to break the gold standard, in which allowed them to print a lot of money to help to create a lot of employment in the market. But in this way that he do, right, accidentally also caused the US dollars to plummet. This indirectly also impact the OPEC countries because, right, all the oil contract have been priced in US dollars because they're not able to redeem their US dollar in exchange of gold. So in year 1973, October, so President Nixon requested 2.2 billion from Congress in the military support act for the Israel. The Arab members of the OPEC country decided to halve the oil supply to US and all the Israel allies. This had causing the US oil prices increase from $2.90 per barrel to $11.65 per barrel in 5 months. Just within a 5 months period of time. And this had caused a great high inflation happening in the US in 1970. So at that point of time, the gold price had been increased 18 times, okay, because of the bringing of money. Secondly, will be the cyclical growth companies. Example, banks, semiconductor, and mining companies are the good company that you can invest during the inflationary environment. Thirdly, will be real estate, also doing very well at that point of time. So lastly, I want to mention this to you. We call it as a black swan event. This term is popularized by Nancy Nicholas Taleb, who is a finance professor, former Wall Street trader, and a writer. So for these black swan events, right, it's always happening in an unpredictable way and also causing a severe consequences to the market itself. So example, like what happened during the 2008-2009 Lehman Brothers crisis. So no one ever thought, right, hey, investing in property can also go crash, but actually it do happen in the US itself. So what do you think are the asset class that can be prepared for this black swan event? So for me, I will prepare cash for my portfolio to be prepared for this black swan event. So for mine, I will put gold, bonds, mature and stable, structural growth companies, cyclical companies, real estate, and cash into my portfolio. So the next question will be thinking, okay, this sounds like a good plan. Actually, you have everything in your portfolio, but how it can really beneficial for you as an investor? Okay, let me draw to you this very exciting question. So let's say we do a comparison, 100% equities versus asset allocation. So we use the 1929 Great Depression as an example. So I'm using the Dow Jones Industrial Average and the gold price. 100% equities, compare asset allocation, 50% in equities, 25% in gold, and 25% in cash. So this is the breakdown of the 100,000, 50,000, 25,000, 25,000, 100,000. So in year 1934, the 100,000 you have, right, if you invested fully in equities, it will drop to 25.9K. So compared to asset allocation, it will drop to about 80,000. So 80,000 is coming from 25.9K plus 42K plus 25K. How do you feel after you invest for 5 years, 100,000 turn into 80,000? I believe you feel not very happy, right? But let's say if compared to 100% equities, are you feeling much better now? I guess so, right? But if you continue to wait for another 20 years, 1934 to 1954, then you will recover back your 100,000. As compared to asset allocation, you will have been accumulating additional 17,000. Okay, so you have been investing for 25 years and you are making about 17,000. Are you happy? Actually, not even 1% a year. Okay, so for me, right, besides I doing asset allocations for my portfolio, I also actively look into my portfolio, do a switching when there is a needed. So for me, so this one is the same chart that I shown previously. Actually, it's the same thing happening in the today's situation. Actually, this is what I did during the last year circuit breaker period, before this March crash. Yeah, during last year. So actually, I holding 20% equities before March 2020. So after it dropped 30%, so I decided to increase my equity exposure to 35%. And I decided that if let's say the market continue to drop another 20%, I will increase my equity exposure to 50%. So I will do a asset allocation switching accordingly. So let's say the market dropped 90%. For me, I will not hold 100% into equities. What I do, the maximum I will hold is about 70% equities, 15% I will put into gold, and 15% I will put into cash. So example, in 1934, this 80,000 that I have, I will switch to this allocation. So example, 70% of equities of 80,000 will be 56,000. So 15% of gold of this 80,000 will be 12,000. Same amount, 80,000. But if you wait for another 20 years, your portfolio has been growing to 185,000. So are you feeling better now? You get about 85,000 for the 25 years have been investing. Maybe some of you might be thinking, okay, it may not be a very great achievement, but for me, I'm thinking by using this asset allocation, it can help me to write out the volatility and not being so worried about my 100% equities will be dropped until this point of time. Yeah, so for me, I want to prefer to enjoy investing over the next 20 years without much volatility happening in my portfolio. I hope this has been beneficial for you. As you like what I'm sharing, as you have any comments, please help me to comment below. I would like to hear from you. That's all from me. Thank you for hearing from me today. Look forward for my next episode. Thank you.